Hey guys, welcome to another episode of One-on-One with John Steingraber. I have a special guest, good friend and colleague of mine, John Palumbo here. He's from Freedom Mortgage, so we're gonna be breaking down all the different programs for financing for first-time buyers, investors, and we're also gonna talk about a few other things that are gonna be really interesting. If you're tuning in for the very first time, definitely check out our other shows, subscribe to us on YouTube, and if you can, just tag somebody in this post, whether it's an investor, or somebody that's renting, right? They don't know about mortgage financing. We're gonna talk about 15-year mortgages, 30-year mortgages, the difference, how to save money. We're also gonna give you some awesome resources for mortgage calculators and things like that. So I'm excited about today's conversation with John Palumbo. He's been a really, really good friend of mine and a great resource to help me build my business and also a lot of our agents over at Signature Realty. So John, why don't you say hi to everybody?
Sure. Thank you, John. So good to be here with you guys. I always appreciate working with you, and thank you for the opportunity. So again, my name is John Palumbo. I'm with Freedom. I've been a mortgage banker now for the past 16 years, and I have a great team of guys that I work with. Love the business, very passionate about what we do, and just great to be here. So talking some good mortgage stuff today.
Yeah, so there's people from New Jersey watching, but there's also people probably from different parts of the country that are either seeing it on YouTube or on Facebook.
Sure. Right,
the video is going to be on the internet for a while. So why don't you just start out by, telling everybody, where do you guys lend? What states?
So Freedom is nationwide. We lend all across the country. Myself, I'm licensed in a few states here on the East Coast. I do business in New Jersey, New York, Connecticut, Florida. I also have, I just picked up my California license as well.
Oh, great.
But if we run in any other states that I don't lend in, I will refer to one of my partners that does lend in those states. So yeah, we're a nationwide company. We're the 5th largest in the country at the moment, and we're growing like crazy. We're the #1 VA lender in the country. I know I've mentioned that a lot when we go out. We do a lot for the veterans. We really appreciate their service. Yeah, Freedom's a great company to work for.
So is it easy to get your license in these different states?
So the first step is to go through, there's testing. You have to do 20 hours of education. You have to pass your SAFE test. There's an individual test for each state. The tests are not easy, so they make them a little bit challenging. A lot of people fail them, but you can keep retaking them. After you fail it the 3rd time, you're gonna have to wait 6 months. But if you prepare yourself and you go through the courses that there's good information out there and good books you can get and courses you can take to prepare yourself for the test. But once you do that, and then you have to pass your background check. And this is really important because back when I started, there was no testing. There was basically no accountability. If you could be a mortgage person, there was really no background checks done. Which is kind of crazy because real estate agents have always gone through testing and had to get licensed. So finally they passed these laws, which I think cleaned up the industry a lot, which is good.
That's good. So tell us about your team, the production level that you do, just so people can get an idea of, you're not just your average mortgage broker. All mortgage bankers are not created equal, right? Yeah. So that's why we work with you, and that's why I want to invite you on the show to really give people a really good resource. But why don't you talk a little bit about how big your team is and what do you guys do in volume, like how many loans or whatever you want to share.
So we work out of a small office in Totowa, in New Jersey, in North Jersey, and we've been growing. We've hired some really great people. I have about now 8 salespeople that I work with on my team that I coach, and they're doing very well. They're hustlers. They get out there. The mortgage business is never an easy one, but if we look for people that are very they're go-getters. They want to go out there. They want to meet people. They want to work. There's a ton of business in the industry. I always say that there's when you get out there, there's enough business for everyone. It's just a matter of getting out there and doing it. And myself, when I started 16 years back, in the beginning was challenging, like any other sales job. It always is difficult in the beginning. 16 years in, I'm now one of the top producers in my company. We average probably about 35 units a month. My small office closes about 30 to 35 deals a month, and we plan to keep growing that.
That's awesome.
So yeah, it's just been going great. Myself, I average about 15 to 20 loans in a month on average, which is not easy to do unless you have a great team behind you. So I have a good operational staff. I have 3 assistants in my office who are also licensed salespeople, and it's important to be able to delegate. I'm able to delegate to my team. I trust what they do. They're very good at what they do. We have people that have been working in this industry for 20, 25 years. So we come with a lot of experience, a lot of knowledge, and Freedom as a company has all the products out there. So we really, and we're always looking for the next best thing that's available in the market. What's our competition doing? Our technology is always going to be cutting edge. We're always looking at the next best thing to make the mortgage process easier.
Right.
And because it's not easy. The banks don't make it easy.
So what's the difference, right? What's the difference between going to my local bank, right?
Sure.
Chase, TD Bank, or whatever bank that you bank at,
yeah,
versus going with somebody like you?
So
I've never really understood the difference other than just working with you. I know that there's always a vast, options of programs, but why don't, coming from the pro himself, give me an idea of why somebody would go to you.
So it's very different from what we do and what a bank may do. We only do mortgages. So we're a mortgage lender. We don't do checking accounts or open up, we don't do IRAs or any other types of savings accounts. We only focus on the mortgage business. So when you go into a bank, the mortgage side is a small piece of maybe what they do, or it could be a large piece of what they do. It depends on the lender. But we really have all the products that you need so that when I take a deal, I'm not really limited. I'll know where to fit it, and I'll know that, okay, I could say, okay, well, this doesn't work based on credit, or the debt to income ratio is just way high.
So you can get more creative and educate the client a little bit more.
Exactly. A bank is a lot more conservative. They're very strict. They look for a certain type of borrower. Whereas we lend, for example, in the 500 range on a FICO score, where a bank will not even come close to touching that.
So what is the lowest credit score? Actually, that's a question that I didn't have here that I wanted to put.
We actually go down to a 500 credit score.
Wow.
We have a Freedom First program that allows a borrower. It has to make sense. Yeah. We are one of those lenders that will think outside the box. So if the deal makes sense, for example, you have a borrower that's just made a couple late payments or went through a divorce or something, but they qualify. They have a good job. They have some money saved in the bank, but their credit score is at a 540. We will consider doing that deal. We've closed many. You can get away with, even at a 580 credit score, you can get away with as little as 3.5% down on an FHA. So this is what really separates us from a lender like a bank, where they would not even consider doing anything. They set their own overlays. They make it a lot more strict. They're very conservative. Another thing that we do is that we have we're a direct lender. So I have immediate access to my underwriters. My processors sit next to me.
They're in-house.
Everything is done in-house. So we're not a broker where we're sending a file out and losing complete control.
Right, because you don't have a relationship with them, and
exactly,
you can talk things out.
Right.
Get the documents quicker.
When something goes wrong, we get on a call. We look at ways to fix it.
Right.
We're not here to kill deals. We're here to make them work.
Right.
And that's really what sets us apart from a bank, for example.
Right. And do you work with somebody that says, I want to buy a house in the future, but I don't think I'm ready yet. I want to know kind of what I should, think about doing, like, fixing my credit or, setting myself up in a way. Do you guys do things like that?
Yeah, so I love borrowers that are serious about buying, even if they're challenged, they have credit issues, they may not have the money saved. If they're serious about buying, I'm happy to work with them 6 months, a year, 2 years. There's clients I've worked with for years who I still stay in touch with, but I know that they're not in the position now, but I know that they will be if they follow. Yeah, so a lot of times I'll advise them to go see maybe a credit person. They can look online to they can find someone who is good at, for example, maybe deleting things off their credit and cleaning up the credit. Or if they don't have money saved, I can let them know, start saving this much money every month, just to kind of get them. You don't need that much money these days to buy a house. You can get away with 3% down. If you're a veteran, it's 100% financing. If you could just,
So on a $300,000 house, somebody needs $9,000.
Yeah.
And investors, I think one of the main reasons why I have John on the show too is more and more every time I bring him or, one of the people from Freedom Mortgage like Chris Alessio that's on your team, and you guys are talking about the programs that you guys do. It's pretty amazing. The response from the audience at our events, because they're like, oh my God, like I had no idea I could do that, because we had Dave from Alpha Funding on our last show, right? He does hard money lending, and he'll do 90% financing, 100% financing sometimes if you have a relationship with them, but the rates are 9, 10%, a couple
and there's
points. And
Yep.
a lot of people don't know that if you have good credit, you have good income, on an investment property even, you could put as low as 15% down.
Yes,
on a single family. Why don't you break down that for the people in the audience that are looking for, first, I would say, an investment property. Let's talk about that. Mm-hmm. And then what would it look like for a first-time home buyer, but somebody that really is willing to take on a project that needs work. So we'll talk a little bit about maybe the 203K rehab loan.
Yeah.
So talk about the Fannie Mae home style loan and how that works.
So this is a great product for investors that's really underutilized. And I do a lot of them, my team does a lot of them, and we're always out educating people on this product because like you said, a lot of people don't really know it's even out there. Right. They automatically think they have to go the hard money route or private money. And sometimes that is the best way to go. You know, we've talked about this where if you have to close in 7 to 10 days,
right.
you have to go the hard money route. There's no
right, because it's going to take your team how long to close?
It's going to take at least 30 to 45 days.
Okay.
If it's a very massive, large project, it can take even up to 60 days. It depends on.
But if people start prepping ahead of time,
yeah.
right? I just did a refinance with you guys. I've worked with you guys a lot. You guys have all my documents.
Yeah.
So really, I'm updating my bank statements. Right? We're ordering the appraisal, the title, right. And it could probably get done quicker if people have already done business with you too.
Yeah, of course. Any repeat customers are always
right.
easy. A lot of times I'll even take that same borrower to the same underwriter who's already familiar with your file.
Got it.
It's a matter of updating a pay stub, a bank statement,
right.
a couple things have to be updated, updating the credit report. That's a very easy, smooth transaction moving forward once it's a repeat customer.
So how fast could you get a loan done for me, knowing that we just did one last week?
For yourself, you can get a loan done within 3 to 4 weeks.
Oh, okay. So that's still within that time period of when I make an offer, right? Even on an investment property, we can close in 3 to 4 weeks.
Yeah, we can definitely close in 3 to 4 weeks. Yeah. Purchase transaction normally takes about 45 days. But if if we already have all your paperwork in place, we've closed them as early as even 2.5, 3 weeks. We've closed them. Right. You know, as quick as.
Just got to stay on top of everybody.
Exactly. Sometimes I have an attorney that's very slow, so I always tell my borrowers, listen, I'll do everything on my side as long as there's no issue with the appraisal coming in.
Right.
Title work is clean. Your attorney's doing their job on their side.
Right.
The seller's doing what they have to do on their side. Because there's so many parts of a transaction. We're kind of the hub of it, where we have to make sure that everyone's doing their job.
I think buyers underestimate that. At Signature Realty, we're always educating the buyer, like, hey, make sure that the attorney that you're using does only real estate, right? Because if they're in court half the day, because they're a trial attorney and they're handling your transaction, there's going to be times that they get back to the office at 4 o'clock, right, 5 o'clock, and they're not working on your file. They're catching up on voicemails, emails, and they're not working on your file, and all that does play into it. But let's stick with what we talked about. So let's say somebody's buying a $300,000 investment property, and the renovation is another $100,000. Tell me, total cost of everything is $400 grand. They would have to put 15% of what?
15% down of the total. Now, along with the reno, if
so 15% of 400,000.
Yes, but if it's 100,000 base in reno, we also add additional things into the reno, including things like permits, if there's an architect or an engineer, draw disbursements, title updates. We hold back another 10 to 15% automatically as what's called a contingency reserve. This is in case money, like for example, you take down a wall and discover there's broken pipes, and that wasn't accounted for. So there's an extra 10 to 15% that we build in automatically as extra money. So figure that 100 becomes maybe 125 or 130, let's say, after all said and done, depending on the project. And then you have to take 15% of the total. Of the total. So figure about.
So let's say the 100 includes the contingency.
Yes, let's say it all includes.
So it's like 75 plus 25. So we have $400,000 total. They would need $60,000 down payment. And Joey, if we could show the screen, awesome. So $60,000 down payment. So that's the down. Total amount. So then they would need closing costs.
Closing costs. Figure closing costs are going to run you about $10,000 to $12,000.
Right. So let's say $10,000 to keep it simple.
Yeah.
Right. And do they need reserves in their bank account?
They need 6 months reserves just to show. Okay, just
6 months of just mortgage
of the
payment?
mortgage payment,
not taxes and insurance.
Total,
So
including taxes and insurance.
if the mortgage payment on a let's say 340, right? Because if they're putting 60 grand down on 400.
Say it's in the 3,000 range. Okay, say it's about $3,000 or so. You need that times 6, so about $18,000.
So another $18,000 in reserves. Okay, and what does this interest rate look like for this investment property? This isn't a house somebody's going to live in. Yeah. This is a house typically that somebody's going to resell.
So the rates on investment properties are always going to be a little higher. The good thing about Freedom is that we do not sell higher rates on this product. Anytime you talk to a lender, they'll always tell you, the rates are a little higher on this. They're always going to be higher on a 203K or a home style. These are renovation loans. They're not for us. We really dominate the market with this product. So figure the rate. If the credit's very good, you're in the low 5 range on a 30-year fix. Could be a 5.25. Could be maybe even less. There's no points generally involved as long as your credit is good. Our fees are the same fees as any other type of transaction. We generally, in the state of New Jersey, charge $695, which is very, very low. And then you have the costs associated, of course, with the loan itself that are part of the rehab.
Right, like an appraisal.
These
$500, $550.
Exactly. There's the normal closing cost that you're going to pay an attorney, title. You're going to
right, but that doesn't have anything to do with you.
Right. So
that's the $10,000 in closing costs
Yeah.
that we put. So let me break this down. So purchasing, let's say, a fixer upper for $300,000, your renovation with contingency is about $100,000. You need to bring about $70,000 to the table, and then have $18,000 in my bank account for reserves. Now, do I have to make monthly payments on this?
So one of the nice things too is that you can include, if the house is under construction, let's say for 6 months,
Right.
you can include those payments into the mortgage itself.
So this
we can add-
$18,000 that I would have to pay over 6 months,
Yes,
we
you
could
can
just add it to
finance
the
it into the mortgage as additional. You can carry into the loan. So you would be putting nothing out of pocket at all. You would not put anything out of pocket.
So
which
I
is
don't have
great.
that monthly payment.
Yeah.
Does that include taxes and insurance?
Yes.
Wow. So I have no monthly payment. Utilities. That's it. Maybe a
Utilities-
little landscaping,
Yeah,
snow removal.
your
if
other
it's during the
carrying
winter.
cost, of course, but nothing out of pocket. Because here's the idea with this is that we expect that you're going to be, if it's a buy and hold, you're going to be renting this property, but it's vacant. So we want to make sure that you can afford to carry this property.
Right.
So we allow you that option to finance the mortgage payments into the loan. Your mortgage payments always begin a month after you close. So for example, if we close in the month of May, okay, you don't pay May, you don't pay June. July 1st is your first payment. Technically, you have to the 15th. You have a 15-day grace period. So 2 months later, you're making a payment, but the house is probably still under construction for another few months. So we will allow you to build it in, which is nice. And so that it gives you time to fix it.
And what happens on the 7th month? I'm not done yet. What happens on that month?
If the loan was set up with 6 months of payments, at that point you're responsible to make the mortgage payment.
And what kind of, is it a huge mortgage payment because I didn't pay my first 6 months?
No. So
or
what
is it
happens
the same
is
as
it's your normal mortgage payment. So every month the payment is due. The bank is taking it from your escrow and covering the payments with it because we've already financed it into the loan.
Right.
Once that gets depleted, then we have to, the borrower has to start putting in money to cover the mortgage payment. Yeah, but it's a great option for an investor, right? Because they're always looking at money out of pocket,
right,
and they're not putting anything out of pocket except for their cost to close.
Right.
And
they're $70,000, and then they have to have some money in the bank account.
Exactly.
And this doesn't get frozen up, their reserves. They just have to have it at
just to
closing.
show. Just to show.
Then they can use it afterwards.
Yeah.
Okay.
Right.
Great.
So it's
on this
an
deal,
awesome
you would
product.
need about $90,000 total, right, to do this. And if you look at it cash on cash, if you're going to buy a house, fix it up, and sell it, and let's say they were going to make $45,000 in profit, right? Let's say even in a year, they put out $90,000 and they're getting $45,000 back, plus their $90,000, right? Because they're going to get their equity and all that money back.
That's a great return.
That's a 50% ROI.
It's huge.
And that's in 1 year. It could be if you do this twice, right? That's 100%. You could double your money in a year with the right knowledge and the right training. I like this program.
It's a great product. It's for single family investments only. Then there's
so I can't buy a multifamily with this.
Not with this. So with multifamily, what you need to do is go the hard money route or the private money route. This product specifically is only for single family investors. If it's a primary home, now you can do it 1 to 4 family.
Got it.
And,
so tell us about that.
So under a renovation loan, you have this same product, which you can put as little as 3% down on a single family for a primary home buyer, and 2 family would be 15% down, and 3 and 4 families is 25% down. But we have the alternative to that is the FHA, the 203K, which is probably the more common one that you hear out there in the market.
Let's talk about that.
Yeah, 203K works just like this, where you can finance all the rehab into the loan itself. And
so 100% financing on the rehab?
Well, you're putting minimum is 3.5% down on an FHA.
But 3.5 on the purchase,
the total,
or the whole thing?
Same thing, same concept. So the total, right? So if you have the same scenario there where you're going with a $300,000 house and it needs 100 of work, it's 3.5% of 400,000 as your minimum down, and then you have your closing cost as well. Same thing. You can also finance the monthly payments into the loan. And again, the concept here is if you have a first-time buyer, generally they're renters. They're renting somewhere, and they're still paying rent where they're living. We're not going to expect them to pay rent where they're living and start paying a mortgage on this property for the next few months. Right. That can, they may not be able to afford that. So it's set up the same way as a home-style loan, but requires very, very little money down. And this is a great one for multifamilies.
Okay, so let's say 3.5% down of $400,000. Pretty sure that's $14,000. Then we have $10,000 in closing costs. Any reserves?
No. So for 1 to 2 family, there are no reserves. 3 and 4 does require 3 months in reserves on
Okay, so
on an
1 to
FHA.
2 family, 0 reserves.
Right.
And what did you say about
3 to 4 requires 3 months in reserves. And reserves can be like if you have, for example,
3 months?
3 months reserves,
3
correct.
months.
So if you have a 401k or some type of retirement account.
That counts.
Yeah, absolutely. As long as you can show proof, we're going to ask you for the terms. As long as you can show proof that you can draw against it, we will use it as a reserve. We take a percentage of it. We'll take 65% of it. We're not going to use the full amount. Depending on the loan, we'll take anywhere from 65 to 75% of the retirement account. But absolutely, that does count as a reserve. All right. So this is a great product as well. A lot of agents are afraid to go into a house that's a big wreck. But, you know, as an agent, I think it opens up a whole new world of inventory for you and for your buyer, because you can get your buyer a really good deal on a house that just needs work.
Right, this house, if you buy it for 300, you put 100 into it, you're into it for 400, but it could be worth 475 when it's done. And you get to customize it the way you want.
Exactly.
That's what we talked about the first time homebuyer seminar.
And that's another point is that you walk into a house a lot of times as a realtor and they just say, oh, I wish I could redo this kitchen. Kitchens are expensive to redo. Bathrooms are very expensive to redo. If they can understand that there's a product out there for them, which just is a little bit more work involved, we have really perfected how these loans work. We have departments that just do these loans. We have underwriters that are that's all that they underwrite, that they know how to underwrite, they understand how these loans work. The problem is that you have lenders out there that say that they do these loans, but they only do a few. And it becomes a disaster. It becomes a big nightmare for the buyer.
Takes forever.
Yeah, and so a lot of agents just get a really bad taste in their mouth. We specialize in them.
So let's talk about some of the things that we're allowed to do, what we're not allowed to do. So one thing I'm not allowed to do is fix up the house myself, correct?
Yeah, let's
talk about that so people can get a real good picture of this.
Self-help is we're not really allowed to do it. In some instances, for example, if it's a home style loan, let's say you're a carpenter, you work for a carpentry company, and there's some carpentry work involved. We'll, on a case-by-case basis, allow you to do part of the work. But for the most part, it's not allowed. And it's a conflict of interest. We start these loans where the first step is to get an estimate from a contractor. If it's someone you know or you're doing it yourself, you may undercut the budget where you're not financing, there's not going to be enough money to finish the project.
Right.
So that's really the problem. So on a case-by-case basis, I'll get something approved, but generally it's not allowed.
Okay, so we're talking about licensed and insured contractors. Do they have to have a special license? Do they have to be on a certain list?
No, so as long as they meet the requirements of the state, they're properly licensed, they have workman's comp if it's required for their state, they're licensed. We want to see that they have some experience doing residential construction. You know, if they're only working on commercial properties, is this the right person to do this job? So we're going to ask them for a few references. We urge and we recommend for the client to find their own contractor. We want them to work with somebody that they're comfortable with. We never want to push anyone on them. As a matter of fact, we as a lender don't even recommend contractors. The HUD consultants, if there's a consultant involved in these projects, and I'll touch on that real quick, depending on the scope of the job, if it's, for example, a $35,000 or more reno on an FHA or a $50,000 reno or higher on a conventional home style, it will require a consultant, okay? The consultant is a HUD-approved consultant that we set them up with. The consultant goes to the property and really works to protect the bank, but also to protect the homeowner, exactly. They're gonna set a budget, and then the contractor has to stay in line with this budget. And they're going to address all the mandatory items that have to be done on the property that the bank will require, and then the desired items. We can add in the desired items as well. But this protects the homeowner because they're going to set a realistic budget. So as a first-time buyer...
So the HUD consultant might say, wait, this budget's way off. Let me go back to the contractor and make it adjust. You're paying way too much for this. You're paying way too little for this.
Exactly.
And then they make the adjustment. So it protects that first-time home buyer.
Exactly.
Which makes sense because, you know, to qualify for FHA 203K, my understanding is you have to be a first-time buyer?
You don't necessarily have to be a first-time buyer. It has to be a primary residence.
Okay. And so if I already own a home, I can sell that home, and if I'm going to buy it to live in, I can still qualify for FHA.
Even if you don't necessarily even have to sell it. As long as you're justifying your move to a new property and it's a primary residence and you don't already have an FHA mortgage, you are allowed to get an FHA mortgage or a home style, one or the other. It's kind of a misconception that FHA is for first-time buyers only. It's not. You can, as a matter of fact, sell the property if it's an FHA that you have and get into another FHA right after. But this is a great program that a lot of buyers, we do, in certain areas that you work in. For example, you deal with a lot of bank-owned homes. You have to go in with a renovation loan.
Right.
So some agents
it even
really,
says on the listing sometimes, cash or renovation.
Or renovation. And it really, again, opens up a whole nother level of inventory for an agent and for buyers out there. There's a lot of good property out there. They're in good areas, but they're distressed. They've been vacant for a while, or they just don't meet the needs of the buyer. This is the loan that they need to go into and understand that is out there.
Right, and it's also important to have a good agent, right?
Yeah.
Like, at Signature Realty, one of the biggest things that we do is we teach our agents about, dealing with investors and contractors and things like that. We recommend them, at least in the New Jersey area, our kitchen cabinet guy, the guy who does countertops. Like, they're going to save a ton of money on that. Yeah. And, and everything else from mason to roofer to cider to somebody that does carpentry and plumbing, electricity, floors, all that stuff is super important. And I think the more that you work with an experienced agent and mortgage rep all together, I think that's when there's that profit to be made for that homeowner so they could build that equity.
The borrower really rely on us to guide them the right way.
Right.
So they rely on your expertise as an agent, me as a mortgage person to put them into the right product. And we're always trying to, of course, save them money, get them approved, and get them into the best program that is out there. And this one here, for example, this 203Ks, we've been getting a ton of them because people now are starting to become more educated about the fact that they're out there, that there is a product for them, and that they can get into a home and not have to worry about, fixing kitchens and bathrooms and redoing the home with money that they don't have.
Do they have to keep the house a certain amount of time, or can they sell it 6 months after, even if they did a program like the FHA?
Yeah. So when you're going into a property, into a primary home, you're signing documents at closing that are saying that you're promising to live there for 1 year.
For 1 year. Okay.
Yeah. That's usually the requirement is 1 year. However, can you sell it after 6 months? There's no restrictions against selling the property.
Right. Who's going to tell you can't sell it?
It's your property.
But you're saying that my intent is to
live there for at least 1 year.
To live there for at least 1 year.
That's
okay,
right.
Great. Mm-hmm. And if you're a second-time buyer, and I already, I purchased a home, I got a mortgage, FHA, now I'm a second-time buyer, is it still 3.5% down, or do I have to put more?
So as a secondary buyer, you're either buying as an investment or you're buying as a secondary home. Second homes are typically like in the shore area.
No, not second home. Let's say I'm selling my house and then I'm going to go live in another primary.
Oh yeah, no, you're still primary. You can still buy as a primary.
You can still do 3.5% down.
You can still do 3.5 down. You can do.
And if I'm a veteran with the VA loan, I could do 100% financing.
You can.
So nothing down.
Nothing down.
What's reserve?
So generally, it depends on the findings that we run these loans through an AUS system. It may or may not call for reserves depending on how high the debt to income ratios are. Generally, there are no reserves on VA loans. 100% financing all day long. This is a great product. We do a ton of them. And of course, you're responsible for your closing costs, which you can even build in. You can do a seller concession, build that in as well. We've done VA loans with very minimal money out of a borrower's pocket.
Right. The tough part about the VA loan that we've seen in good markets, right?
Yeah, sometimes the appraisals are a little bit more conservative as well. I've seen that happen as well with the appraisers. The greatest thing about a VA loan, it doesn't carry mortgage insurance. So 100% financing, if you're going into an FHA or a conventional, you're paying mortgage insurance. FHA, you're paying this upfront MIP, right, to the government. It's 1.75% that the government takes on top of the monthly, which in some instances is there for the life of the loan. If you're putting less than 10% down, the mortgage insurance is there for the life of the loan. On a conventional, it's a little different depending on the product. It could be there as little as 2 years on a conventional, but you're paying mortgage insurance unless you're putting 20% down. The VA doesn't work that way. There is a funding fee involved that's paid to the VA, but again, depends on your eligibility. A veteran has a certificate of eligibility. And that certificate will tell you whether or not they're responsible to pay any kind of funding fee. Some of them are exempt because they're disabled. There is no funding fee. But these loans carry no mortgage insurance, which is a great, great savings to the buyer. Another thing with VA loans is that I've seen them go up so high as 65, 70% debt to income ratio. When we qualify a borrower, we qualify them based on their debt versus their income. What we call a debt to income ratio calculation.
So wait, let's get to that in a second. I want to talk about this PMI for a second.
Yeah.
So everybody, I think, does this change the PMI or does it stay the same?
On conventional or?
Yeah, so let's talk about it. So on conventional, so let's do the FHA. FHA, we just said 3.5% down, right? So obviously it's going to require PMI.
Yeah, it's gonna require PMI.
And that would be for the life of the loan because it's less than 10%.
Exactly. So
and that would be, so it's 1.75% of the purchase or the loan amount?
No, so the upfront, which is financed into the loan, is 1.75% of the loan amount.
Okay, so if it's a $100,000 loan, it would be
$1,750. It would be financed
over the year?
No, it's just financed into the mortgage. It's a one-time thing that gets financed into the loan. So you're borrowing that, it's tacked onto your base loan. So after you put 3.5
So it just increases
down,
your monthly payment a little bit because
yeah,
you're
because
financing.
it's financed into the loan. Exactly.
So on $100,000, right? Let's do times, 3, right? 300,000. Mm-hmm. Right? We're talking about 3 times 1750 times 3 is it
would be 1.75% of 300.
Right. So it'd be 1,750 for every 100,000, right?
Mm-hmm. Correct.
All right, so let's do that number. 3 times 1,750.
So in this case, let me run this down for you. If you're taking $300,000, let's say that the price is $300,000.
Right.
Okay. You're putting 3.5% down on 300.
Right.
So you're putting 10,500 down. Okay.
Okay.
So your actual base loan is 289.5.
Okay.
Then you take 1.75% of that number. So your MIP would be $5,066.25.
$5,066.
Yes.
Finance into the loan.
Added to the base loan.
So how much would that increase my payment?
About $25.
But
yeah, about $25, $25 bucks.
That's nothing.
For every $10,000, you're looking at about a $50 or so increase in payment. So it's about
the
$25.
PMI isn't $175.
So that's the upfront. That's one part of it.
Oh,
then
okay.
you have the monthly, which is built into the mortgage payment.
So how much is the monthly?
So
this is upfront.
It's based on the loan amount. Okay, so in this case, you're looking at a mortgage payment. Let's see here. Think about 0.85% divided by 12. In this case, you're looking at about a $200 or so mortgage insurance monthly into the payment.
So 205 plus potentially the
plus
25.
Taxes, insurance, principal and interest.
No, but just for PMI on a
Just the PMI is about $200 a month.
On a $290,000 loan,
yeah.
290 because you put the 3.5% down on those 300.
Right.
It increases our payment by $230 per month. If we are a veteran, we save this $230 a month.
Yes. There's no mortgage insurance.
And how do we not have to pay this? You put more than how much down? 20%?
So unfortunately with the FHA, it doesn't matter. You're still paying mortgage insurance.
Okay, so you would have to do a conventional.
So
if you did a conventional with, what is the lowest down payment that I can put that I can avoid the PMI?
20%. Now, there's many options out there though that you can actually have lender paid mortgage insurance. You can buy out the mortgage insurance in one shot. If I have a borrower that has a debt to income ratio a little bit above the limit,
right,
where they're just exceeding it, we can get creative and say, okay, your mortgage insurance would be about $200 a month if you're only putting 10% down, let's say. I will give you the option of paying $7,000 or $5,000, let's say, into the closing cost as extra to buy out the mortgage insurance in one shot.
100%.
100%.
So you never have to pay the monthly payment?
That's it. You pay it one time, you buy it out, it's done.
So that makes a lot more sense.
It does make sense if the borrower has the money. There's a break-even point. So when you do the math, if it's, how long is it going to take you to
4 or 5 years?
Yeah, sometimes it's even 3 years. It depends on the buyout.
Wow. So that's a really good option that I think.
Great. It's a great option.
And does it help you if they do that? Does it hurt you?
No, it doesn't. It doesn't affect me in any way. In terms
so you're not making money or losing money on that?
No, it doesn't. It has no bearing on what we make on profit on a deal. It's more so the payment changes for the borrower and it allows them to going from not qualifying to qualifying.
Right. So as a realtor, I should know this.
Yeah.
Right. As a realtor, right? If you're a realtor and you're watching this, if you don't have these conversations with a mortgage rep, or you don't have a broker that brings in somebody to train you on this stuff, this is something that you can explain to your borrower, like, hey, ask your mortgage broker about this. And do you think a lot of mortgage brokers push for that or even talk about that or educate the client on that?
So, a lot do, but a lot don't. They don't know. They don't know what's out there. They don't know the different products that are out there.
Because that, I mean, I'm thinking about this. That's you're talking what, $2,500 a year.
Yeah.
If you tell me, hey, you could pay $5,000 in 2 years, I paid off. If you tell me $7,000, it's not even 3 years break even.
Yeah. So one of the questions I always have for the client is, what's your long-term intentions with this home?
Right.
Are you staying there? Oh, we'll be here for the next 10 years for sure. We're not moving ever. Then I give them this option.
Right.
I always present it to them. And again, our best interest is for the client to save them money. What's going to work best for them?
Right.
So
and
they need to know that stuff is out there.
As an agent, can I now negotiate, for example, you tell them that, right? I say, hey, you got to ask the mortgage rep, John, about paying your PMI up front because you're going to be here for the next 10 or 15 years.
Yeah.
It's probably better because there's an FHA loan. Let's just pay that off. That's going to be paid at closing.
It's going to be paid at closing.
So
but
we
only
can get them a seller.
Only on conventional, not on FHA though. Only conventional.
So maybe I can negotiate with the seller to pay that for them.
You could. You can include you can throw in a seller concession.
Right, as long as it appraises.
Yep.
Right, and we can get the property appraised. Like if they're getting it at 300 and it appraises at 310, we can do a $10,000 seller's concession.
And that's a great point because so what happens when you have excess seller concession? The seller can keep it, right? They're not required to give it to you. So if the closing costs come out to $8,000, but my seller concession is 10, there's an excess of $2,000. The seller technically keeps that money. Okay, so what do? We try to eat it up. We try to buy out mortgage insurance. We'll buy down the interest rate. We'll charge them a half a point or a point. Whereas we can eat that up and we can get them savings in a different way because that money's just going to go to waste.
And it's all math too. I'm pretty big on math, and if I look at this, I'm thinking, okay, wait a second. If I have an offer, right? Somebody's putting in a $290,000 offer, right? That's the buyer. And the seller counters, and the seller goes, no, I want $300,000 for the house. That's only a $10,000 increase, right? Yeah. And that $10,000 is going to be about $52 a month, right?
Sure.
So about $50 a month in a 30-year mortgage, right? 30-year mortgage. So for the buyer, it's just going to be that. So we could potentially, that $50 is worth less, right, is worth less in financing a mortgage than taking another $10,000 saying, okay, seller, I'll agree to your $300, but I want to go up to $310 and I want $10,000 in seller's concession, right? So now what happens is, even though I'm paying $310, right, $20,000 more for the property, that mortgage payment goes down.
Yeah.
Because at $290, I had a mortgage payment at, let's say, what would you guess, $1,500 a month?
Mm-hmm. Okay.
Right, $1,500. At $300,000, I have $1,550, right? But then at $310, it goes down.
That's right.
$200 a month because I'm saving on the PMI.
That's right.
Right, so now I'm at $1,350 per month, right? Instead of being at the $1,550 right here, and I literally just got the mortgage down even lower than at the $290 price.
Yeah. So a lot of times buyers are looking at that payment. They're not really looking at,
right.
They don't really understand the breakdown sometimes. They're looking at, I can't afford this. It's just too high. How do we get this thing down? And that's how you get it down. There's also options to do what's called a lender paid mortgage insurance, where we increase the rate slightly and we pay for the mortgage insurance for them. Generally, when I do the math on that, in the long run, it doesn't make sense because the rate is higher.
Right.
This is the best option because they buy it out, it's done, and they're still locking in at a low interest rate.
Right.
Okay.
So let's talk about that. Let's talk about a 15-year versus a 30-year now. What is the difference between, I erased that, a 15-year versus a 30-year on, rate, mortgage payment?
So rate, it's safe to say, and again, this all depends on the size of the loan, the type of product, because it
so
does
let's say
vary.
$400,000.
So figure
$400,000 loan.
Yeah, the rate should be about 0.5% better on a 15-year mortgage. Okay, so right now, if rates are in the low 4 range, let's say in the market, right, they're in that 4 range, that low 4 range, you're probably somewhere in that upper 3 range. Let's say 3 3/4 range.
So 3.75?
Yeah, I would say 3.75. This is without buying it down. If you decide to buy it down, you can get maybe in the mid 3s, maybe even into the low 3s. Okay, but if you use that as an example, about 0.5% better in an interest rate.
So a 30-year would be 4.25 about.
Yeah, approximately. I would say in the low 4s right now.
Right.
That's
so
average.
Okay, great. I want to talk about this. This is good.
Yeah.
So what would be the total interest? So we did a couple numbers because we were talking about this before.
Mm-hmm.
What's a 15-year mortgage payment on a $400,000 loan? Obviously, your monthly payment's going to be higher, right, on a 15-year because you're only paying it off in 15 years.
So on a $400,000 loan, your payment will be at $29.08 a month. Just principal and interest we're talking.
29, yeah, of course.
Yeah,
and then the
29.08
30-year?
a month. 30-year, you're looking at a payment of, let's say the rate is out of 4.25, interest
19.
400,000, 30-year term, 4.25. You're looking at a payment of about $19.67 a month.
So it's almost $1,000 more in a 15-year mortgage.
Yeah.
But what is the total interest over the loan? And we did this
Yeah.
on a calculator. So on a 15-year mortgage, it was $128,000 in total interest, right? And on a 30-year loan, it was $308,000 in total interest.
So the difference is
or 305, I think it was.
305.
So 305 minus 128 is what?
177,000 in savings.
Right, so you have 177,000 in savings by doing a 15-year loan, by having a monthly payment of $1,000, almost $1,000 higher per month. Wow. So if you're buying a house, what are you doing?
So my advice,
what do you recommend to people?
So the 15-year mortgage is a huge money saver, right? But you have to be able to afford it. I would never, when I interview a client, one of the things I always ask them, I know what they qualify for based on their credentials. I could tell based on their income, what they're carrying, but I always tell them, you need to understand what your lifestyle is, where you like to spend money, because I don't see everything on paper. So we have clients that like to go out a lot, they travel, they have to they know their comfort zone. If they can qualify for a 15-year, it's just the way to go. They save so much money in the long term on this thing.
And it also depends on how long you're going to be in the house.
Exactly.
If you're going to be in the house 3 years, then...
Yeah, it may not make sense. Now, can they pay extra money every month to the principal? They could, and that might be the better way to go, just to go with a 30-year and pay extra.
But do people do that?
They don't. It's hard for them to discipline themselves enough to do it consistently. If you go into a 15-year mortgage, you're locked into a 15-year mortgage, you have no choice. So what are the benefits? You're paying a ton less in interest, your interest rate is much less. And one day when you go and sell this property, you're going to thank yourself that you did a 15-year loan, because you're going to pull so much more equity out of that house versus if you were just in a 30.
Because the mortgage gets paid down a lot quicker.
A lot quicker. And when you're looking at an amortization schedule on a 30, you're paying so much in interest over especially the first few years of the loan.
Right.
So today, rates have slightly dropped. So we're trying to take some 30-year mortgages, and it doesn't make much sense to refi maybe if it's a quarter better or even 0.5% better, because there's cost to refinance.
Right.
So there has to be a benefit. So what we do is we educate them on the 15-year mortgage, explain to them, look, if you cut the term from a 30 now to a 15, and the rate's 0.5% better or 0.75% better, there's a huge benefit to you now to do the refinance. Now it makes sense. Even if you go from a 30-year to a 25 or a 20-year term, okay? It's when you go to the 15 and 10 where the rate drops a little bit more.
Right.
But you have, there's still benefits to do a 25 or a 20
And 15 years goes by quick.
It does.
I mean, it
does.
By the time you blink, 15 years have passed.
Yeah.
You have your house paid off.
Right.
That's good. Now, if you're an investor, right, because there's probably a lot of investors, and I've taught trainings and seminars, and, one thing that it does to your debt to income ratio, which we'll talk about in a minute, it's harder to qualify for another loan because now you have a payment that you have to pay, right, of $29.08 versus this $19.67. So your DTI is affected, but if you have the additional income, right, you do it. Yeah. And some people say, well, you could pay off a 30-year loan in 22 years, right? If you pay a loan if you pay your mortgage payments every 2 weeks.
All you're doing there is you're paying extra.
Right, you're paying one more month, right?
Yeah,
because there's 26 payments.
Yeah, you're paying one extra payment, and what that does is it's going to accelerate the term.
Right.
So if you do an amortization schedule and you put in an extra payment,
every
you'll see exactly, depending on the size of the loan, how much you're going to save and how much sooner you're going to pay that loan off. Right. And going back to investors will typically tell you, keep the payment as low as possible.
Right.
I'm an investor myself. I disagree with that. I personally, because my intention is to hold my properties long term, and I just want to
buy and hold, right?
I just do buy and holds. So I just want to hold them, pay them off, and then just collect profit on those.
Right.
So to me, the less money I can give to the bank, the better I am. Even though it's costing me a little bit more every month, the majority of my properties have 15-year mortgages on them. So it's just, every year that goes by, it's just great to see how much that principal drops.
Right.
And
your tenants are paying down.
Yeah, they're paying it. They're still.
So you're not cash flowing so much.
Exactly.
You're building equity.
Exactly.
Now there's two ways to look at that, right?
Yes.
Some people look at, okay, I'm trying to build equity.
Right.
In 15 years, I'm going to retire. So now I have the house paid off, and then everything is profit other than taxes, insurance, and like maintenance.
Correct.
Right. And some people, because they're actively working, they're paying all their bills with that. Some people want cash flow.
Yeah, they want to reinvest that money.
Right. They want to get more cash flow coming in to pay their bills now, depending on how old you are, right?
Sure.
So
it depends on what works for you.
Right.
Depends on.
There's no right or wrong answer.
No.
No. And that's why we have people like you and people like me that we go, all right, let's break it down.
Yeah.
Right. Just like when we talked to first-time homebuyers, we did a first-time homebuyer seminar, which was awesome.
Yeah.
Right. We had about 80 people there, and we're going to do some more. Just really breaking down. Okay, do you want to buy a single family or a multifamily? Right. If you buy a two-family, you live in it. Right, and you rent the other one out. What did you do on your first house? Did you buy a single or a multi?
So I started with my first few houses were multis. I think the best
Even your
way
primary?
To start. Yes. Initially, what I did is I bought my first two-family. Then I moved from that two-family to another two-family, and then eventually, after I think my third two-family, I moved to my one-family. Okay. But I think it's the smartest. And I was a young kid. I started investing when I was 22 years old. I started buying houses. I always, my mom is a real estate agent. She got me into the business as a young kid. That's what got me into doing mortgages. And I was like, looking at these deals, I'm saying, wait a minute, if I can do these mortgages for these people and she's getting these houses for these people, why can't I buy a house? And it was so easy back then to get a mortgage. So anyone can qualify. So I started buying when I was young. But what I did is I was smart with it because I bought two-family houses and I was able to cover my expenses just from the rents. I put very little money out of my pocket. And then from there, I moved on to another one, and that's what I did. And then I just, and I've kept all the homes.
And you still have them?
They've always been rented. They've always been cash flowing. I've refinanced some of them just to cut the terms down. They're not cash flowing as much, but they're being paid. They're being paid down a lot faster. And then I moved to my one-family house eventually. So I think as a first-time buyer, I think it's so smart if you can get a house with rental income.
Right.
Of course, you have to deal with tenants.
Right.
And some people don't want to deal with that. They have that fear.
Right.
But there's always a risk in real estate. There's always that risk of what happens if I have a vacant apartment. It can happen.
Right.
But if you're a good landlord, I think, and you take care of your house,
right.
Rental market's very strong. I've barely ever had a vacancy. Mm-hmm. But I'm very good with my tenants. I take care of them. If something goes wrong, I'm there. Right. You're the same way.
Right.
I know how you are with your tenants.
And you have the home warranty program too that you've talked to me about.
Something
that a lot of people breaks. I don't think they know about their rentals can have a warranty program. When something breaks, you just put in a claim, right?
Exactly. So the whole point is to be as headache-free as possible.
Right.
And we manage our own properties. I know I manage a lot of mine. But the home warranty's on them. The tenants can call in the claim themselves. It's $35 to $50 for them to put in a claim.
A service call.
And it's a service call. They come in. If they can't fix it, they generally will replace it. That saved me so much time, headache. And I've met a lot of good people through the warranty companies, good contractors, good people that have good reviews, and that I still do business with. Because it's good to have a good team.
Yeah.
So when something breaks, you have a plumber, an electrician, someone who's reliable. A lot of these people are reliable. These companies do try and hire people that are vetted well and that they're reliable people. So it's worked out that way with the properties.
That's good that you recommend that.
Yeah.
I like that. Now some people just want a single family and that's fine.
And that's fine.
But should somebody that buys a single family, should they look at some point buying a 2-family, 3-family for their future?
Sure. I mean, what better way to invest in passive income than buying at least 1 or 2 properties to have for the future. Let's face it, we don't know where the economy is going with, are we going to get our Social Security or we're not going to get our Social Security? I think investing in the real estate is just such a smart thing that everyone should do. Even a small investment.
If you have 2 properties paid off in 15 years and it's bringing you $2,000 a month each, that's a little pension, right?
Exactly.
That's $50,000 a year.
Exactly.
Some people work 25 years to get a pension like that.
Exactly. I think it's the best return on your money. Your money sitting in the bank is not really doing anything. Some people like to invest in the stock market. If you're good with the stock market, then that's great. I'm not good with the stock market.
Right.
To me,
but we should talk about diversifying, right?
Yes.
You diversify. You don't put all your eggs in one basket. If you have 401k money, a lot of people have that money already in the stock market.
Yeah.
Take some of your other cash and invest it in this. And in real estate, that'll be another topic. But you can self-direct your 401ks and IRAs
Exactly.
and buy rentals.
Yep, you can reinvest
Right within your retirement account. I shared that with my wife again the other day, and she goes, "Oh my God, I forgot about that. Let's do it." And I'm like, "Okay."
Because it makes probably so much a better return on your money. Absolutely. And there's a lot of very good, reliable people that do great work. We know a lot that we've worked with.
Yeah.
And these people are very smart in reinvesting, taking from their retirement accounts and reinvesting into property and projects.
Right.
Yeah.
So you've been a member of our real estate club for how long now? 10 years, 11 years?
Since the beginning, yeah.
Since 11 years.
We've hit 11 years now.
Yeah, and Jerry. So how has networking and building those relationships helped your business? So now talk to, the professionals, the investors, the realtors, the other people out there that are building their business, because you're a top producer. I mean, you're in the top of the nation when it comes to mortgages. So talk a little bit about how have you built your business, the mindset, the networking, talk a little bit about that.
So NJRESN, I always say, has really changed my life. I think just getting in front of people, the amount of people the amount of contacts that we've made there. We started the club small, it was mostly realtors in the beginning, and then it just blew up once we shifted it towards real estate investors. And I have to say that just being there, the education, first of all, I've learned so much just watching you present and all the different speakers that we had on board. I think it's so important to just learn. Even in what we do as a mortgage banker, we're constantly, new guidelines are coming out. If I'm not on top of what's going on in the market, my competition will crush me. But I always know the answer, and if I don't, I will find out the answer. So that's very important. So NJRESN has just taught me every aspect of their investing, whether it's marketing or, we've talked about so many different topics. Right. And I've had the opportunity to also meet so many great people that I do business with every day. It's amazing how I'll do an event and 6 months later I'll get a phone call, "Hey, I met you at this event." So one of the things that's worked for me is just getting out there.
Yeah, it's consistency.
I do so many events. People at some point get to know your face. Right. Or someone like, for example, Michelle, right? She's very big into marketing, so she's doing a lot of mailers. People almost get to know her without really knowing her. Yeah. She's in everyone's mailbox, which is just great. So same concept. If you're out there and you're constantly, freedom is, we try to be in every place that we can be. So that's really, it's given me a good name, a good reputation in the industry, and it's been able to help me build my career over the last 16 years. So NJRESN for me has been the best thing ever. I love the group, and now I have the opportunity to host the one in Totowa, which is a lot of fun. So it's been a great ride. So I know we're going to continue to open up new chapters with NJRESN and do some good things with it. But it's been great.
That's awesome. Yeah. And there's so much more to these topics, right, that we can talk about and go really, really deep. The most important thing is, knowing some of it, and then, having somebody like you on your team that we could refer to you, because we're not going to stay on top of every mortgage guideline, right? That's why you have somebody like you on your team. That's why you have a realtor on your team. That's why you have, an attorney, right? You can't stay up with everything, but knowing the basics like we talked about today, and then also knowing that, being aware that all these programs are out there for people, and then having somebody like you on your team, I think is huge. So I know you're super busy. I don't want to take up a ton of your time. First of all, I want to say thank you for, coming out, educating everybody on this, and any last words of advice that you have for either investors or first-time buyers or homeowners? Yeah, sure. No, so my word of advice is just always educate yourselves, understand. As a buyer, buyers today are a lot savvier. They're more educated. They're more wary of their credit. They're saving money. Because again, when I first started, it was just so easy to get a loan. So now we have a lot more educated buyers going out there, and it's just great to just get a few different opinions when you're shopping for a mortgage. It's very important to work with somebody that is reputable, that has all the products, because the last thing you want to do is limit yourself to one specific product because that lender only has that one product for you, okay? So definitely, look around when you're shopping for a mortgage. It's very important, and work with somebody that knows what they're doing. For the investors, continue to attend events like we do at NJRESN and other events that are out there. There's so much to learn, and I've always learned also from just experience, right? I went in as a young kid, and it's always a risk involved. I started buying my first house when I was just a kid, 22 years old. And that I learned my mistakes. I was able to learn what I did wrong, what I could do better the next one around. And it just gets easier from there. So, real estate is a great thing to invest in. That's it. And just continue educating yourself, really.
That's my biggest
Always
advice.
be curious if you're an agent. Really, if you're working with a mortgage rep already, really be curious and asking them those questions. We're kind of used to just relying on people. Like a doctor, right? You rely on that doctor.
You have to ask questions.
But you ask questions, and if you have somebody like John on your team to help you break it down, and I love it because this stuff like the back of your hand. It's not like you're looking at your notes. This is what you do every day.
Right.
And you can explain it to borrowers in a really simple language too. So, the more curious that you are about what is out there, the easier it's going to be for you to know how to do this. I mean, even something as simple as debt to income ratio and understanding how that works. Sometimes, one time I remember paying off a borrower's car as part of the deal, right? So he was buying a house from me, and I said, all right, you can't qualify based on the price that I need you to have because you have this $4,000 in your car, right? Payment that you still owe $300 a month on. And I said, let's just increase the price $4,000, pay off your car loan.
Smart.
And then you qualify.
And
that's the only reason I did that is because you taught me about debt to income ratio.
Yep.
And okay, you need to be at 42% of, X amount, and, understanding those formulas is key. So reach out to John Palumbo from Freedom Mortgage. He's at every one of our events. He hosts our event in Totowa, New Jersey. So if you want to see him live as well, you can see him there, or at Garwood, right, in NJSN. And I just want to thank also Signature Realty and Jay. That's all the agents that are watching this and learning. If you're out there and you're a real estate agent and you're looking to get a lot more training, definitely reach out to us via our website, signaturerealtynj.com. Check out the careers page, and always thank one of our sponsors, Alpha Funding. They do hard money lending. So if you're an investor and you're looking for funding, they also do not just New Jersey, but they do other states as well. Check out their website, and that'll be on the screen too. So thanks, guys, for tuning in. Comment on this Facebook or YouTube or whatever it is that you're watching this on. Tag somebody that you think should get this information, and definitely reach out to us if you have any questions. Thanks for tuning in. Check out our previous episodes, and we'll see you soon on the next one.
Thanks, guys.
Good stuff. All right, so we're gonna play for charity. Always be the change.
Let's do it.
$100.
$100.
Let's go. All right.
Ready? 3,
This I don't know about.
2, 1, go!
Oh no. Damn, I can't make a shot. Oh shit. Gotta get in the groove.
Hold on. I'm getting there.
Maybe I should use my back foot. There you go.
You won. You got it. You didn't get the 30 though.
1, go!
Oh no. Yeah. Oh no. My God.
Oh, yeah, I'm getting crushed.
No, you're not.
Dude, my balls are going to yours.
All right, you got killed on this.
Oh my God.
It's already past 30.
Ready? 3, 2, 1, go!
There you go.
Good advice. Good advice.
Good advice.
Yeah, what the heck?
Just hand you over the money now. Oh, it's terrible. Shit, this thing isn't fixed. Just like a record? Oh, forget it. Wow. Oh.
All right, so
I got crushed.
ping pong.
Ping pong it is.
right, Johnny. So I won the Papa shot. Now we're gonna do this one.
Yep.
You owe already $100 to be the
Already
change.
$100 in the hole.
If
Charity,
I
which is
lose
good.
to this, then I give be the change $100 too. It's not gonna cancel each other out.
Perfect.
All right, you ready?
I'm ready.
You said you're really good at this, so you gotta win. Game 11.
I have no choice, yeah.
Volley for serve.
Yep.
All right, your
All right.
serve. 1-0. One up. 2-1, you're up. My serve?
Yeah. Oh, snazzy.
Let. Ooh, 4-1. Six. Getting killed over here.
Oh, I'll take it. 8-1, baby. What's up, Johnny?
Right? Or am I wrong?
We're playing to 11. Woo! Did you get that?
210? Well, now it's yours.
I think he's got the spins on me. You don't know.
3. You got game point.
Wait, so isn't your serve?
He's distracting me. No, so you got to win. 1 for John Palumbo. Ready?
Yep. Oh,
Let.
come on, what a weak serve.
All right, 1-0.
Making me
2-0.
nervous, Johnny.
I don't know.
Nervous.
I'm not doing good here. All right, 2-1. Two up.
Ooh.
Get that one. 3-2. Ooh, 3s.
Caboose, huh? Oh, yeah.
I'm out of balls.
Yep.
4-3. Son of a. Five, 4. Got him.
Oh, I got nothing.
6-4. Let's go.
Ready?
Yep. Mother. Oh, let.
Oh.
Got
Oh
him.
my God.
Got you back.
Today.
8-7.
Nice run, nice run. But is it gonna be enough? 9-7. Oh, game point. Don't mess it up, Johnny. $100, baby. All for charity.
That's great.
Good job.
So, I won Papa Shot, but you
did.
won Ping Pong.
I did.
So, Be the Change NJ, Dr. Bo. You got $200 coming your way, $100 from me, $100 from John.
You got it.
So, good stuff. All good for charity,
Good game.
right? Good stuff. Thanks for coming on the show.
Thank you.